So hi everyone, this is Typhon Capital Management's April 2017 quarterly recap and outlook. We're joined with all of our US-based portfolio managers. It's a little bit late for our British friends, but maybe we'll get them a little later. We'll see. And we're going to be making these calls, kind of moving them to the quarterly schedule. I know we just did one last month, but the next one will be in July, so stay tuned for dial information there. And we're going to start off this broadcast with George Michalopoulos. He's the head of our Leonidas Global Macro and Energy Group that is launching like any day now, both in our Argos fund structure and in a separately managed account, energy-only strategy. And our CIO, Dave Klusendorf, aka Clue, we'll be talking to him about what George sees here. So guys, go ahead.
George, always good to see you. We've seen a disconnection between bonds and the ES over the last couple of days. Do you see that continuing going forward?
Yeah, I think there's a bad habit of seeing one as sort of the mirror of the other, and I think we can see that in short-term bursts. But if you zoom out a little bit on those graphs, they're much more correlated in terms of their return than you might expect since 2008, and actually even longer than that, in the sense that bonds have been rising in price at the same time from bottom left to top right as equities have. And I think the more worrisome disconnect of that correlation might happen in the event of a liquidation or a sort of panic selling moment in markets in general, partially due to the rising popularity of the risk parity funds. And you could have the kind of issue where a sell-off in assets causes a need for managers to sell quality assets to raise capital. Excuse me, I have a couple of devils here. So that would be my biggest worry in terms of a correlation change in the two assets. But in the status quo, I would expect both to continue to have a positive gain.
Well, how is that going to affect your trade ideas? Do you find that your trade construction will take a more longer term look, or do you expect to see these shocks to the stock market to play a major role in what you look for as far as your outlook and as you're putting your trades together?
Yeah, I think that's the trickiest part of the market right now, in that some of the last remaining edge is in patience and longer time horizon investing. And of course, that's in conflict with what investors want. And so balancing the need to have edge and P&L and high Sharpe over the long term for investors with their impatience in waiting for those returns is, I think, what makes portfolio construction difficult right now. That's luckily, talking in my book here, why I think options are a great place to be constructing a portfolio, because I think you can manage both expectations the best with basically distribution bets on the market. So you need to have some positive carry, which you can do in options pretty easily with theta and near-term type of risk assets, and yet have some exposure to tail events should some of the headwinds, whether they be geopolitical or high asset prices in general, or just really a crowded space in ETFs and high leverage and reaching peak housing and peak autos, all kind of sort of black swans on the horizon that you need to be able to protect against and even make money in. But while you wait, collect and make money in the status quo. So I think basically that having the positive carry allows for you to manage the expectations and produce for investors in the short term, day to day, while also having the asymmetric upside for the tail events should they happen. And I believe it's just a matter of time. And that's sort of the story of 2017, 2018.
Thanks. I appreciate it. It was very enlightening. James, can we actually move to Gallo next? Because there's a real good, connection here by what George was explaining and what, Gallo really feels about trading.
Yeah, absolutely. So by Gallo, he's referring to James Gallo, who's the head portfolio manager in our Vulcan Metal strategy. And why don't you two guys go right ahead?
So James, George hit on, the trading what you need to do and yet looking out for these events. And, I know that that's part of your philosophy. Can you expand on that a little bit and talk about, planning for those events and how that incorporates in what you do day to day?
Right. Well, we look more at a shorter term scenario. So our position on longer term, out of nowhere kind of moves are, listen, there are times you're going to catch them, there are times you're not. Okay. So overall, the course of a trading career, or course of a trading lifespan for a particular fund, we feel, a lot of times that could be a 50-50 proposition. So we do have our position set up with some longer term option positions at all times that we try and put into our portfolio for some protection against those moves. We don't feel they're very tradable, but we feel we can still continue to make money on them, if that makes any sense.
Well, it certainly does. From there, can you expand a little bit on, this lower volatility environment and, what that really means for not only base metals, but precious as well?
Oh, we'll take them separately. Well, naturally. Actually, we're going to take them in three different parts because gold and silver have kind of, to a certain extent, diverged with their open interest. I'll get to that in a second. Regarding base metals, right now, what we consider a relatively low volatility in copper, but we are seeing a higher volatility, aluminum, zinc, and some of those type of metals. The big market factor coming into play now is China. Now, it's not like traditionally how we think of China as just a user of commodities. They have really ramped up their production in mining fields and whatnot. The problems we're having is getting good information. How much are they mining? How much? Where is it going? Naturally, a lot of things remain under wraps there. So we are taking some knowledge from and garnering information from different sources that we would. In the old days, we're looking at people who are doing flyovers to mining areas and things of that nature and movements of trucks. And it's down to things like this that we've really gotten back to old time basic of trying to get a feel on what they're actually doing in China. So regarding to the volatility part, it's always a roll of the dice when it comes to not knowing. So we prefer to have our positions wrapped up in copper, where is kind of our familiarity, and it's more U.S. based to a certain extent. When we start to get into zinc and alley, we're more into the unknown. So we like to focus more on the copper sector in trading the base metals, also because naturally the CME provides a great vehicle to trade it as well. So regarding our volatility in those markets, we prefer to trade copper right now as opposed to the other ones because of the higher volatility possibility in the other ones, where all of a sudden a Chinese mine could say, boom, we are stopping to produce zinc like other mines have done, and prices go to the roof. And that's something we don't really like to expose ourselves to. We prefer to act after a situation like that happens and then deal with it. Trying to pick those out of a hat that's really not what our specialty in Vulcan is. We focus more on a day-to-day, week-to-week type of trading, but we always have to have some exposure naturally to longer-term events. Regarding gold and silver, we're seeing a period, particularly in silver, of a little bit of added volatility. We have open interest about 5% from our 2-year highs in silver, so which is very interesting. We're seeing a large bets being made in the silver market, and seems to be the speculative open interest is coming in on the long side of that. So we look for added continued volatility. We saw a sharp downward move in the beginning of February, which was a very, very volatile move. And it's been kind of a steady uphill climb in silver. But with silver, that tends to be their trademark: up slightly, up slightly, up slightly, down very big. So that's something we're monitoring right now. Right now, we are trending to be long silver in our positions, and looking forward to the roll where we can take advantage of wider contango prices to buy forward metal, which we also seem to be seeing some metal being used in the silver market. Regarding gold, we had it was a volatile move, early February, down move, and then we have since slowly crept up to our recent highs, more or less. And the thing that's interesting about gold is about 20% open interest off our highs during the election, which was, as we know, mid-November. So we are seeing a very, very limited exposure that funds have to gold right now. So we feel that if they come in, or some geopolitical event that George had spoken to comes into play, we feel there could be big upside in gold with added open interest. There's a lot of space. There is a lot of room to add new longs in gold with our traditional open interest numbers that we look at. So that's about it on that end.
All right. Thanks, James. Thank you very much. We're going to move on to Proteus with Matt and Mike Thompson.
All right. Hit us.
Good to see you, Matt and Mike. We had an unusual curve in VIX yesterday morning with backwardation taking place. Can we talk a little bit about what that traditionally means for VIX and ES, and do you see that continuing?
Sure. So just real quickly, Proteus, just for everyone's sake, is we trade dynamic volatility, so it's VIX futures, long and short, on a systematic basis. So a backward curve to us. So what we saw yesterday, briefly in the morning, it didn't close this way, but the front month, April, was slightly over May, which is fairly unusual. It indicates some stress in the equity markets, some bid for protection. That's generally our signal for Proteus to get more defensive and to start adding some long exposure to the portfolio. It's not necessarily a brief intraday flash isn't enough to get us to move that portfolio completely to the long bias, but we are on our way there. We have some a spread on right now along some April and shorts in May. But it was interesting to us because that was the first time that we've seen any kind of backwardation in the curve, any kind of stress since the election, since actually before the election. So I think, we're looking at kind of a rounding top a little bit in the equity market, and you're starting to see a little bit of that stress come through in the VIX market. So we might finally be getting a little change in pace here.
Do you feel that the Proteus model lends itself well to this type of environment where we could possibly have this occur more and more often?
Yeah, I think so. I think we're term structure traders, so the front end of the curve is pretty flat. So there's low cost to carry in the front end of the curve, and there's still some decent carry in the back end of the curve. And if we do have a equity correction that's quick or sharp, the front end of the curve is where all the action will be. So we like that along the front and short in the back when the curve term structure looks how it does now.
All right. Thanks, guys. Really appreciate it. All right, let's move on to Jared, and let's talk a little bit of the ags that's been going on. We had a good crop report last week. Jared, would you like to address that a little bit? What you saw in the crop report and what it could possibly mean for prices going forward?
Sure. Yeah. Thanks, Clue. Last Friday, USDA put out their annual planting acres and first quarterly stocks report as of March 1. And what we saw here in this report was corn and bean acres virtually the same. And potentially, depending on spring weather, we may see bean acres exceed corn for the first time in history. Corn was a little bit light on acres compared to expectations. Beans were a million and a half acres more than what the traders expected. So maybe slightly friendly corn, a little bit negative beans. Wheat acres would be if the spring acres are where the government says that they are, would be the lowest wheat acres we've seen since they started keeping track of records back in 1919. So potentially with some weather there, we could see some surprises, but stocks not only here but around the globe are heavy. Corn, beans, wheat stocks, all just a little bit above trade expectations, so probably just a little bit negative there. Interestingly, after the close, equipment and traders report came out and showed funds, much heavier short corn and wheat than the trade was expecting. So, we think corn, as far as a price right here in this 360 versus the May month, probably has just a little bit of value, at least until we start seeing some seeds hit the ground here in some of the I-states and across the heart of the Midwest. We go 4 to 6 weeks down the road. If weather is good, that's not to say we can't start working lower again, but right now we think there's probably a little value there. Beans, have fell overpriced for 2 years and just can't break. The demand has been just outstanding. It continues to, exceed all expectations. China, hunger for protein continues to just keep flipping along at record pace. South American crops continue to grow. Yield data is coming in, probably even a little bit better than expectations. So we see big crops continue to get bigger down there. So all in all, the report, I would say, if anything, was possibly a little neutral corn, but probably a little bit more negative than anything. Looking ahead here, we start watching weather a little bit closer here the next 4 to 6 week forecast. Little cooler, little wetter maybe than ideal, but we'll start watching planning progress and for opportunities to, going forward. I think we're going to see quite a few opportunities here in some wheat spreads coming forward, and I like the opportunity of seeing a lot of the relationships between these grains in the next month or two.
Thanks, Jared. You answered part 2. I was going to quiz you about weather a little bit, but you went over it. Thank you very much. We really had a good month of March. If you look at, when the newsletter comes out, look at the returns, you're going to see some really good consistency right across the board. And, we're really starting to hit our stride in what we do as a firm and what we're about and how we're expressing ourselves. So I really was pleased with the first quarter and looking forward to see, how the next 3 months are going to unfold. So back to you, Mr. Catoulis.
I'm sorry, I was muted. Damien was able to join us from London, and why don't you talk to him about his adventures in DAX trading with the Helios Deutsche program?
Damien, good to see you.
Hey, Cleo, how's it going?
I'm doing good. Hey, can we just start with the
I think.
He has a good background.
Yeah.
Can we, speaking of backgrounds, can we just start with that? Can you give a brief overview of what Helios is and, how you go about expressing your trading ideas?
Sure, yeah. So we're a short-term trading CTA. So we hold positions between sort of 2 and 5 days. We're looking to exploit the noise that occurs in the DAX. We've looked at the last 60 years worth of data in the DAX, and we've looked for patterns that tend to recur again and again over time, and we will look to trade that as we see fit, based off certain algorithms that we've written here. So our returns average around 10% annualized a year with around 10% vol. So much improved Sharpe ratio from what you get with just trading the DAX itself. The strategy works over other indices as well, but the DAX works particularly well for us because it's just that much more volatile than compared to the other indices here in Europe. It's obviously hasn't been very volatile of late. DAX vol is average is around 20%. It's currently more like about 10, which is one of the reasons our returns have dropped dropped off a bit. We were only up 10 basis points the first quarter, off slightly last month. But I think we're well positioned for if we see an uptick in vol, the model should really kick in, and we should get some of the shapes that we'd expect to see in the market pan out.
What are your concerns as the UK's method of Brexit, and those plans start to reveal themselves? What are your real concerns that can throw a monkey wrench into everything?
I mean, from our trading point of view, I think there's no impact at all. I mean, if things went really badly and the whole euro unraveled, then we'd end up trading the DAX and Deutschmarks. But we're pretty relaxed about what Brexit means. Personally, it's kind of a mess, I think. But from a trading standpoint, I think I'm very relaxed. I think the volatility will remain there. The 30 largest companies in Germany will continue to exist, whatever happens. So I'm pretty relaxed from that point of view.
All right, awesome. Thanks, Damien. Appreciate it a great deal.
No worries, Cleo. Thank you.
All right, Mr. Katulis, back to you.
I think with that, let's open the floor up to questions. You could either unmute yourself and say something here, email us at info@typhoncap.com, or put it on the chat in here. You don't want anybody to know who you are. So any questions for any of the PMs, me, Clue, etc.? Okay, well, last call for questions. Or, sorry, someone's trying to talk? From Miami? No? Okay. Well, everyone, thanks for joining us. We're going to have an archive of this up on our YouTube channel, and then a link will also be going out on our next newsletter. And expect the next one of these to be in July. Until then, have a good one. Thanks.
Thanks, guys.